Okay, siamo live. We're live. Welcome back, everyone, to a new episode of our 2024 Masterclass series. As you know, this series was created together with Italians ABC, who a lot of you know already, and the Masterclass has been sponsored and powered by BCG and Beats Place. So we are here today to talk about how to build great deep tech companies with Andrea Traversone, who's a managing partner at the NATO Innovation Fund. Andrea has been investing in deep tech for over 25 years, so we're really grateful that he has agreed to share his knowledge with all of us. Welcome and thank you, Andrea.
Thank you. Very glad to be here.
For those of you who may not know it, the NATO Innovation Fund is notable for being the world's first multi-sovereign venture capital fund, and it aims to invest in startups developing innovative technologies that address defense and security challenges. Under his leadership, the fund focuses on leveraging commercial innovation for critical defense applications and promoting the adoption of emerging and disruptive technologies across the alliance. The fund is supported by 23 NATO allies who act as limited partners, providing patient capital that aligns with the long-term development timelines typical of deep tech innovators. Before we start, I just want to remind everyone that you can ask your own questions to Andrea in the chat function, so please use it. And we will use the last 15 minutes of this session to go through all of your questions. So don't be shy, go ahead and take this opportunity of being live with Andrea to ask your questions. So now let's get started with the questions that we have prepared for you, Andrea. Let's start by defining deep tech. Can you tell us what distinguishes a deep tech company from other tech ventures?
Well, that's a very difficult, complicated question. Deep tech usually means companies that are built on a scientific breakthrough that is often protected by IP and or know-how, often a combination of both. This means that they are based on proprietary development of technology. That doesn't necessarily mean reuse of other technologies, but basically development of their own proprietary stack. So that is what deep tech usually mean.
And in your experience, what is the most fertile ground for deep tech ideas? Is it accurate to think that most deep tech startup companies start as like PhD, postdoc research thesis in academic settings? Or have you seen, different ways to, for founders to basically build a deep tech company?
Yes, in fact, because of the definition of deep tech, inevitably, I would say that the big majority of deep tech companies find their roots in some university or research lab. Often they include PhD work done by some of the founders, but not necessarily all the time. But indeed, they do find that we do find that most deep tech companies are usually born somewhere in their past in a university lab, in a university or a research center, or sometimes a spin out of the research center of a large corporate.
And usually, by the nature of being a deep tech startup, these startups require a lot of upfront capital to develop, their technology. How would you say founders should approach the early fundraising process, and what are some of the funding options that they should consider?
Actually, in most deep tech, probably even I would say in material or semiconductor, actually most of the capital is not needed very early on. The seed rounds mostly in deep tech company are there to attract the team and define the product. Then the significant amount of capital comes in I would say, the second phase, usually around the Series A, Series B, where you're right, there is significantly more capital needed than in non-deep tech company to basically productize the technology or scale it up to commercial level. That is where the capital is needed. And often then in the third phase, actually the capital needs are the same as non-deep tech company. I would actually say that they're probably lower in deep tech at the commercialization and scale-up phase, particularly if it's a well-known business model that doesn't require building a plant or some specialty production processes, because inevitably with deep tech company, you have a much more concentrated customer base, given that they are B2B and not B2C. So the spend in marketing is a small fraction compared to SaaS or fintech or digital marketplaces companies.
And talking about the early funding, which is where a lot of our listeners will be at in terms of phase, a key part of raising money, but also showing that the product has some sort of is a valid product. Founders typically need to demonstrate traction. So just to show that there is demand for their product, start to get a sense for the product market fit. So how can deep tech founders do that if building their first prototype or product is very, very expensive and they need the capital to show the traction? But if they don't have tractions, they can raise capital. I feel like, especially for deep tech, the initial mode is really, really deep. So what have you seen founders do successfully in order to get out of that initial, catch-22 moment?
Yes. When I hear the word traction at the early stage, so seed and pre-seed in deep tech company, I get really scared. There isn't such a thing as traction in deep tech at that stage. And if the entrepreneurs on this call that are talking to VCs and they hear the word traction, I would say run a mile. You're talking to the wrong audience. So the way you find traction, or actually the way that you find third-party fundable milestone for your next round of funding, is basically early stage across three vectors. One, building a great team. And the team here has to be a team that is relevant for the challenge, for the mission, for the focus of the company. There is no point hiring a data analyst in a hardware or semiconductor company. You want someone that has designed semiconductors. So finding relevant team members with the right expertise for the company strategy. That's point number one. And advisors, people who have done it before in that sector. Secondly, it's figuring out the IP strategy, the intellectual property strategy, whether this is patents or know-how or what combination of both, and putting that in place. And third is product definition, understanding what is the product that the market wants in a very crystal way. If you hit those three milestones and the opportunity set is large enough, so the service addressable market is large enough, then I am sure that any entrepreneur will be able to raise capital. Now, defining service addressable market in deep tech is very difficult. What tends to happen is that people look at markets top down from the total addressable market, and then they make wild assumptions about adoption percentages and likelihood. And that is just not the way to do it. The way to do is to identify actually buyers or partners, figuring out how much they could buy of the product, and then aggregate from the bottom up rather than making assumption from the top down. And that is something that, again, should be done before raising the Series A.
For example, I recently read the story of Boom Aerospace. They're startup still because they haven't productized, but they're trying to build commercial supersonic flights. So the next Concorde, but would fly, commercially across the United States and many other destinations. And I read that their way of them, of course, building your first supersonic commercial plane needs a lot of capital up front. But the way they got around and demonstrated traction of product market fit was to go out and collect letters of intent. So go to the various airline companies and say, if we do build this product and it costs this much, how many would you buy? And they were able to get, I think, in the first round, something like $500 million worth letter of intent. And that was a good way to show that there was demand. So do you think and they did all of this with a image, like a really well done 3D image of what the plane would look like, and of course being able to answer a lot of tough questions. What do you think of that story? Do you think that's a typical way that founders go around and show their ideas through a well done 3D model of a product, if it's hardware, or some sort of prototype if it's software, that they can use for first conversations?
Absolutely. That's what I meant by product definition, having a crisp product definition. So to get those letters, they had to define the product clearly enough for those counterparty to write those letters and those references. So in a way, the letters are valuable up to a point. What is really valuable for an investor is the understanding that this team knows exactly what the product needs to look like to be adopted. So in a way, it's more the process rather than the outcome of the process, rather than the letter per se, that is important for an investor.
Mhm. And so just to talk about this stage a little bit more, you said that, as you just said, that product market fit is much harder to achieve for a deep, or it takes a longer time to achieve for a deep tech company. How long does it typically take in your experience, and what are the key steps that deep tech startups should take to effectively start to commercialize their research, and I guess at that point get to product market fit? So yeah, how long and key steps, just to break it down.
The problem with product market fit in deep tech is that fundamentally the company is often 3 to 4 degrees away from the ultimate market. What do I mean by it? So think a semiconductor company. So a semiconductor company needs to have the product designed into a subsystem provider. Think of Foxconn and the likes who do modules for phone makers. Then they have the product to be designed into a phone or whatever piece of hardware that it needs to be designed in. And then this product needs to be launched. Now, as you know well, a lot of consumer electronic products or even business-to-business products, they get all the way there, but then they don't get launched for whatever reasons. And then once they've launched, then you have to make an assumption about adoption. Okay, so as you can see, if you are a semiconductor company, you're actually 4 degrees away from the ultimate demand, which is an individual or an enterprise buying the device with the company's technology in it through 3 degrees of separation. Now, how do you solve for that? That's where the quality of the team comes in. And having people on the team that understand this and the volatility around this, and basically know who to talk into the organizations. So the type of question that a good product manager in a semiconductor company would ask someone like a module maker is this module going into an existing product as an upgrade to an existing customer, or is it a new product to a new customer? Immediately, the chances of the second one are increasingly lower than the first one. And then I would ask, okay, what is the launch ratio of those customers? In other words, you, module maker, have dealt with your customers. How many of their products actually make it to market? So finding the right product manager to ask the right question along the value chain is fundamental on 2 things: understanding product market fit, but even more importantly, understanding the time lag to product market fit, which has a direct correlation to funding needs. And managing investor expectations about that timing is fundamental.
Yeah, that makes me ask, that raises another question. What is the appetite for risk? Is always, part of the game when we talk about startups and venture capital. So whether it's deep tech or, a tech company, like just a regular startup, that comes into play. But it just, as you were talking, it is very clear that in deep tech, the risk is much higher, both of the scientific breakthrough not playing out in the way that one expected, the difficulty in getting to product market fit and finding the right customers, and it being able to scale. So it seems like the road to success for a deep tech company is even more complicated. As an investor, what level of appetite for risk do you have? How do you plan for, or I guess I'm trying to ask the question, like, how do you assess the risk that you have in front of you when a founder first comes to you? What are you looking for?
So there are 2 points to make regarding your question. One is a general, one is a specific one. The general one is that in reality, there is no point talking about risk if we don't talk about reward as well. So in my firm and in my previous firm, we always ended up talking about risk-adjusted returns. yes, the risk could be very high, but if the expected returns are incredibly high, that risk is commensurate with the reward at the end of it. So to just looking at risk per se and in isolation makes no sense. It's always important to look at risk and reward, i.e. upside. Then when it comes to assessing risk, which was your second question. So here there are 2 or 3 learnings. One, to invest in deep tech, you really have to have experience. It's not something that, unfortunately, one can be trained at or learn at university or on an MBA or any other. You just have to live through the experiences. It is very much like a craft. You have to see how these things happen, make mistakes. They often say that to train a VC in deep tech takes $5 to $10 million, and that's absolutely right. It takes $5 to $10 million of mistakes to then make fewer and newer mistakes. And that universe of making mistakes shrinks every time. So fundamental understanding of each subsector is important. Risk in a semiconductor company is totally different than risk in a telecom system company, okay, or in a material company. So having knowledge, specific knowledge in each subsector is fundamental. And then finally, once you are into the subsector, you have to have yourself, you have to build these quadrants that I always talk about, which is known, unknown, knowable, unknowable. So when you're doing due diligence, what are the known knowables? What are the things you know that you can find out in due diligence and assess the risk in that quadrant of the overall risk? So you should spend as little time as possible in that. And then at the opposite hand, you have the unknown, unknowable. How big is the space that you cannot figure out where the risk is and you don't know it up to that one is a very difficult risk to assess unless you've done many deals in that sector and unless you have a very good network of experts in that sectors. And if you do, you make that unknown, unknowable space shrink dramatically. And that's when you change the odds of the returns. And that's where you can take more risks because you have an insight on de-risking the investment for the same return. And that's what good deep tech investors do. They shrink the unknown, unknowable space a priori before investing.
And you have 25 years of experience investing in this space, so you must have seen so much, so many different startups, and some successful ones, and obviously the ones that didn't make it. What would you say are some of the most common pitfalls that founders should avoid when scaling their deep tech ideas from the lab to the market?
So one is believing that they've hit product market fit when they are overreading the signals, when in reality it's not product market fit. It looks like it, but it's not. And it's a little bit self-fulfilling because an entrepreneur always wants to be able to tell themselves, I'm there, I've achieved product market fit, I can show it, but in reality you don't. I've seen many companies having good customer engagement, telling me we are there, we're going to ramp up revenue, we're doing a growth round, only for the revenue actually to go down, not up, because that designing never led to a product launch, for example, as I mentioned before. So really, really being disciplined and objective about product market fit is, and 2, being conservative a priori before starting the journey with your investors about the time it's going to take to get there. And if one is honest about that, they'll find out that it always takes longer, much, much longer. And I mean longer by by 2, 3, sometimes 5 years, which then puts the pressure on the other part of it, which is the reward. If I'm asking my investor to take this risk that is more than they originally thought that they were taking, or they're originally thinking that they take, it has to be commensurate with a potential reward that is much higher. So spending time figuring out what the scale of that market is and how competitive this technology is in that market opportunity is the only way for investor to accept the fact that the journey to get there is going to take longer, is going to take more capital, is going to be more dilution, but the return should be there, because often what tends to happen is that it takes longer and the market is never as big as originally expected. And that's where there is disillusionment and burnout on the side of the entrepreneurs and investors that don't come back after having made one or two investments in deep tech and then just moving to other sectors where the feedback loop is much faster and more evident. And that's where traction becomes important and relevant.
Thank you. And in your experience, should deep tech startups aim to first validate, their technology, what they're building, by starting with like a very narrow use case, and then think of scaling, or should they immediately aim to compete in a big market?
It really depends on a sector by sector basis. Both strategies are good, but there are trade-offs. It's often hard in deep tech to focus in a niche and then pivot to a bigger and bigger market and a bigger horizontal sector. So in certain areas, semiconductor being one, it's probably better to go for the first big market straight away, take the risk, the high risk and high reward path. I've seen very few deep technologies in general where you can de-risk the path to the upside by taking intermediate steps. Is just the issue with deep tech is that they are horizontal technologies, so they have to address large markets on day one. If there are niches, the capital needed to get to product market fit for a niche just doesn't work. So I tend to be more of a fan of really looking at the big upside opportunity rather than going in a step-by-step way in terms of market addressing market that are small and incrementally larger. Because also remember that once you crack the technology and you address that small market, your signal to the market is clear. A competitor will look at that, figure out that technology can address a bigger market, and jump into the market. So there is also the issue about competitive signaling that works against you in that strategy.
I guess the reason to do, and I'm curious to hear what you think, but the reason to do small niche, rather than do small niche, but maybe there's a temptation to do, if you're trying to get to try the easiest version of the technology first. So try with the lowest cost, lowest effort version of the technology that will help you to prove the I don't know, let's say that you want to build specific parts for the aerospace industry. You want to start with the easiest part that you can build to prove your technology, and then get more complex and maybe put in robots in your manufacturing and make it, always more complex, if that makes sense, rather than start with the most complex, highest capital intensive idea and then directly prove that. So do you think one is better than the other, so going step by step, or starting with the big idea and just trying to raise more capital up front to get there? Good, but hopefully.
I understand. I'm leaving it with an investment we're making at the moment. Exactly. With the right team, with the right product strategy, it's always better to attract the capital to go for your second strategy, which is the full big opportunity, big market, full automatization, if you have access to the market, to the funding market. To go it step by step, I've seen it work, but by exception, and it is super hard. So fundamentally it comes down to fundability, i.e. the ability of the entrepreneurs to attract capital. On a similar basis, so, having this equal ability to raise capital, I would always go for the big reward opportunity first.
Now when we created this invite for this masterclass, we gave all the listeners who have tuned in the option to also ask some of their questions. So not only the ones that are coming through in the chat right now, but also previously. And we've selected a few ones that were very interesting. And one of our listeners asked, I framed the problem and the potential solution, but it's now time to move further. I would like to understand the next steps. How do I build deep tech in Italy? I don't know if you have a point of view regarding this.
I think to be honest with you, geography is not a limitation here. You can build a deep tech company wherever you are. It's easier in some markets, it's harder in other in terms of availability of capital. But venture capital is very global. So there are multiple investors that can invest wherever the opportunity is. So if this entrepreneur has a clear problem set that he or she thinks has solved with the technology, I would focus on the three things I said before. I lock in the intellectual property, make sure that you have a very strong, relevant team for that opportunity, and define the product very, very, very specifically. Okay. In other words, almost do a product spec. What is today's product spec, and what is my product spec? And if it is a new product, still, what is the product spec? Because another failure mode is that deep tech companies, they often build the right product spec that doesn't fit with the fabric of the industry. Customers just do not buy that product. They buy a bigger solution, or that product is embedded in someone else's product. So figuring out the go-to-market and the integration path to adoption is equally important. And that drives also the business model of the company. Often what tends to happen is that deep tech companies, they go to market with a solution, meaning I know what the problem is. I have a customer. I'm going to build the solution, that product for that customer. And then, as if by magic, I'm going to try and sell that to all many other customers. In reality, that doesn't work. I haven't even seen it work in software. That becomes a solution business. A solution business is a perfectly viable business, but often is not a venture backable business because the gross margin, the cost of goods sold are too high, because it's often a specific solution for a specific customer that doesn't migrate to other customers. So really understanding whether you are a solution business, the way that you're building it, versus a product business, is another fundamental fail mode of a deep tech company.
And something very important is obviously testing the technology that you're building before launching, and before doing basically the testing phase. How would you recommend to bring on board future customers during that proof of concept or proof of technology phase while still testing the tech? Like, do you go to a very small company in your sector? Like, do you have any best practices on how to navigate this phase of the startup?
The best way is to bring on board a key counterparty in the best customers you can get, who were in the customer and have now left. And today we have LinkedIn. You can find anybody from any company and attract them or contact them. So that this is someone that maybe was at Google or Amazon, and you have this key piece of technology you want to sell to those, and this person has now left. They're maybe in a startup or in a consulting job, or they've left. They are in an advisory level role. They understand the product definition, product market fit, how do these customers buy, and refine your offering with their input. And then go to those big companies and say, hey, I think I have something that actually would be very interesting to you. And because you will basically speak in their language, having been trained by this other advisor, you will find that they give you the time, they give you attention, because they need to innovate themselves. So there is a need for this. Just about how do you approach them, basically.
And another really interesting question that came up is the communication, basically communicating your deep tech startup to investors. Obviously, a lot of the investors are, know a lot, and maybe there is investors who have PhDs and are very, are very scientific. But it can be, you can also have somebody who doesn't really know your sector, and it can be highly technical. Do you have any advice on how to communicate effectively, like really difficult concepts?
What I would advise is to communicate to investors the same way you communicate to customers. At the end of the day, investors, unless they are for some specific reason, real expert in that specific technology, and that would be more, a serendipitous moment, they often are learning themselves. And so the best way to talk to them is to talk to them as customers, because that they can do. They will understand product specification. They'll understand where the product sits in the stack of the customer, and they will think of themselves as customers, and they will figure out, does this make sense or not? So I would approach it that way.
And before we open it up to more questions from the audience, we have a few that are coming through. We wanted to discuss your investment process, just to better understand how you operate as an investor, but hopefully that will also shed some light onto how deep tech investors operate in general. And so what are the key factors that you look for in early stage deep tech startups before deciding to invest? I know we've talked about a lot already in this chat, but if you had to break it down, do you have like a list of 5 things that you're really looking for instance?
In order, actually, once again, it's sector specific, so I will not put them in a priority, but these 3 factors, they are the fundamental ones in each sector. So it is the size of the market opportunity, the strength of the team, and the uniqueness of the technology. Those are the key 3 things that we focus on at the beginning. So at what we call at the top of our funnel, to figure out where to allocate team time, to different opportunities. And this sort of selection is done individually by each team member and as a group. So first it's done by myself, my colleagues, who decide where to allocate their own personal time. And then when it gets brought to the whole partnership, is the whole partnership together that decide to prioritize on one opportunity or another, depending on independent who's bringing it, again, against these 3 criteria. So it's a 2-layer selection, if you wish, in terms of where we allocate our time. And this is a process that, by the way, is absolutely the same pretty much for every VC firm. We're not any different here.
Yeah, but it's important to know that when a founder meets with you or any investor, it's important to make sure that you're really defining those 3 things well, and especially on the addressable market or total market opportunity, that usually is easy enough to, the calculation in theory is easy enough to make, but it's important that it's made in the right way and that it's justified in the right way when meeting with investors. Otherwise, you might immediately exclude some investors because you're not demonstrating a big enough opportunity. So it's an important calculation to make, and maybe remake and change the idea if you're not satisfying the right market opportunity, right? Because maybe you think you have a genius idea, but if it doesn't sell or it doesn't have a market that you can easily calculate, then that makes it harder for VC funds to be interested. Have you seen, how do you want to see that calculation? Because it's easy to find market research and say like the semiconductor market is a $50 billion, I'm making that up, market, right? Or do you look for someone who has actually calculated the market for their specific idea?
Much better the second one. Doing a due diligence call last night with a specialist, and I loved it because he was able to tell me average order size per customer, average selling price per product to those customers, market share by customer, market share by competitive supplier. If you can get to that level of granularity, I get confidence that you as an entrepreneur know the opportunity set and who your customer is, and hopefully how they're going to behave and why, so that you can really fine-tune the product market fit and your product specifications. When I see slides that say, oh, as you said, the semiconductor market or this material market is this big, doesn't do much for me.
Yeah, you probably know that already, but you can read the research online. And in terms of the NATO Innovation Fund, we talked about how you are different in terms of who your LPs are and how you're set up, and your specific focus. In terms of how you work with entrepreneurs, how is that different from any other VC fund that operates in the deep tech space, in your view?
So since I first spoke to Ines, we added one more investor in our fund, which is Sweden. So we now have 24 sovereign wealth fund. And the way we work with them, and the way that differentiate the NATO Innovation Fund is across, I think, across multiple dimensions. So besides the scale of the fund, we are also what in the industry is known as patient capital. So we are quite unique that we are a 15-year fund, because deep tech takes more capital and takes more time. Originally, those that designed the fund designed of NATO a few years ago when it was originally developed, they did a lot of great product market fit work. So they went around multiple venture capitalists around the globe and basically asked them, what's wrong with the tool used to invest in deep tech? And the feedback was consistent: size of the funds and duration of the funds. And so they designed the NATO Innovation Unit that designed the fund in a way that fits the market need. So they designed something that had very good product market fit. And now we see it when we meet entrepreneurs, that they say, wow, this really makes sense, because I need an investor that can be with me for more than 3, 5, 7 years. So that's the first wave of differentiation. So this is the first different interaction that we have with entrepreneurs. We have conversations that are significantly different because we have significant capital to back them, and more importantly, I would say, over a much longer period of time. The second dimension is that all of our investors are also customers of our portfolio company. So we have an adoption team inside our fund whose only task is to support our portfolio company sells into our investors' organizations. And these include anything from Ministry of Defense to Ministry of Economy and Information, in some cases Sovereign Wealth Fund, but basically all the government organizations behind these representatives are all customers. And we have a direct and proprietary access to them. And we really leverage that to basically help our company not only find that product market fit, but refining it, and then really develop the famous traction word, which, much later stage VCs like to see.
And one of another audience question was, do you see any specific segments in robotics that you think could be particularly interesting in the next 10 years for future deep tech investors? But I wanted to broaden that question, actually, and just ask you, is there any specific sector where you see opportunity for more disruption and that you think are particularly interesting for founders to explore in this period of time, in this moment of history?
Yes, our current focus is in 9 what we call emerging disruptive technology areas, which are on our website. These range from quantum computing, new material, next generation communication, hypersonic, and many others that I'll let you check from our website. In terms of robotics for us fits under 2 or 3 of this category. Probably the predominant one is what we call autonomy. So basically, how can you create autonomy in robotics, in any type of vehicles, both ground, air, and subsea, and how can you leverage that? And so that is a big area of strategic interest for us at the moment.
Great. So there's some great questions that have come through. So I'll select one to start and we can discuss it. And I think we've talked a little bit about this, but it's interesting how it's framed. So Luigi is asking, a lot of hardware companies face the valley of death after Series A when the science is proven, so post-product prototype, but product market fit is not there as you haven't hit commercialization yet. How do you advise founders navigating that critical phase?
Yes, that's a very this is exactly the phase I was telling you about, where actually you have the highest capital needs often. So this is where you actually need to spend time identifying the investor that has the most experience in your sector or even subsector. Why? Because they will be able to assess the signals of product market fit before commercialization. Okay. If you're a semiconductor investors and you're looking at revenues, you have missed the boat, because by that time the company is going to ramp up dramatically, and revenues are too much of a lagging indicator of product market fit. So you need to focus on designing. So find a semiconductor investors who understands how designing processes work, who can assess whether you really have a design in or not. And usually by the time you have a design in, you have product market fit, assuming the product is launched, as I was saying before. But between product market fit and revenue, you probably have 2 years. So you need to meet an investor that will see the signal of a design in as significant as revenues. So talk to your networks, talk to the deep tech networks that are available today, and identify the investors that can be a little bit more discerning about product market fit rather than just looking at a revenue or traction. That is really the only way that you're going to crack this one.
Another question came through from Federico. When is a patent mandatory for a deep tech startup? In pre-seed, I personally think that will be too early. That's what he says. Do you agree?
Not only I agree, but I would also challenge that a patent is never mandatory for a deep tech startup. I have backed in many cases startups that didn't have a patent. Often a patent is detrimental to the company protecting their technology, particularly if it is a process. So I would make sure that when we talk about this, we talk about IP strategy, intellectual property strategy. And intellectual property strategy ranges from patents to know-how, and often is actually a combination, a blend of part of both, that is the perfect intellectual property strategy for that company. It is never one or the other, okay? Or very rarely, I should say. So I totally agree that in pre-seed it's too early, but I would also challenge that it's mandatory. It should not be mandatory.
Thank you. Then we have a question from Eduardo asking, when a deep tech company goes into due diligence stage with a fund, what is your advice to founders at this stage? What are the biggest mistakes deep tech founders make?
So this is very much firm and almost individual by individual. So I would focus on building conviction. So figuring out whether the firm, the individual that is looking at the deal, has built the conviction on the thesis, the investment, the team, the product. And whilst they've built conviction, be brutally open about the risk. Okay. There is this very interesting and rude term in the VC industry, which is called the oh shit board meeting. So this is the first board meeting you go to after an investment. And given that now you're an investor, the entrepreneur is at freedom to basically share all the risks and all the mistakes that they've made. And they usually do it at the first board meeting. That's why it's called the oh shit board meeting, because you come back to your partner and you say, oh goodness, what have I done? More and more experienced entrepreneurs have this board meeting or this meeting with the new investors before the investment. And that builds so much credibility and so much strength of relationship between the investor and the entrepreneur, that really puts them both on the same side of the table. So I would do that as an entrepreneur during the due diligence phase once I am confident that that investor, and more importantly, his or her partners, have the conviction to make that investment. Okay. So what is the biggest mistake is when the VCs, they found these things without being told by the entrepreneurs in due diligence. And then the entrepreneur loses all credibility. And you start to wonder what else is there, even if there is obviously nothing there. And you also start to wonder whether you can build a open relationship based on trust with this entrepreneur. I've hardly ever seen a process recover after that. So I would err on the side of openness, transparency, even a little bit over conservatism, after I've reached the point where I'm confident that I've built a conviction.
Yeah, I guess it's tough because one wants to, sell the idea and make it as rosy as possible. But the truth is that once the investor gets into the company, then you have 10 years of work to do together in front of you. So it's important that you set that relationship on the right foot and don't, over I think there's over optimize, like make everything better than it actually is, because then that comes through really quickly once you start working together. That's I can see how that could happen, because we are told to tell the story and fake it till you make it and sell it, but then it's important to do it in the right way and hit the right tone when you're going through that even pitching phase.
And that's why I keep telling entrepreneurs, as you shouldn't feel like you're selling anything. You're not selling me anything. We're coming together in a joint project where most likely than not, I will probably need to sign another check down the line. So what actually you're selling me is a relationship. And how do I measure the quality of the relationship? Well, it's about openness, transparency, and an attitude of working together. So that's actually what you're selling me, not the technology, the product, the opportunity, but you're actually selling me a relationship.
I'll go to the next question. I'll actually go to Guido Walter Di Donato is asking, when can a software startup be considered deep tech? So I guess another question on what does deep tech actually mean and what are you looking for, how you do differentiate the two, sort of how.
Well, in software, it gets a little bit harder, but it still applies. If the software is built on proprietary understanding of some technologies, maybe a proprietary process that has been digitized through software, proprietary models developed, hopefully built on unique or proprietary data, that is all deep tech. Cybersecurity is considered deep tech, and it's for 90% software. So it's much more about the innovation of the product and the barriers to replication. So think of deep tech more in software as barriers to replication. How quickly can this software be replicated? Well, if the software is built on a particular process that is unique to this team in a sector that is very hard to understand, in a process that is very unknown to most operators, then it's deep tech, because it's very hard to replicate.
Another definition question from Emiliano Lepore: are medtech medical devices and bioenhanced devices to treat eye conditions, which I suspect is his startup focus, also in the focus of the fund? And the fund, we mean the NATO Innovation Fund.
Bio enhancement is definitely a thesis of our fund. So we will need to figure out what is the condition and how relevant it is in our world, but definitely bioenhancement is a big area for us. There is a new paper out by NATO that I think was published a couple of weeks ago around biotech and what are the key areas of interest. And the ones that are mentioned in that paper are biosecurity, biomanufacturing, and bioenhancement, including human-computer interfaces. So those are all areas that are of interest to us.
We have another questions from Jonas. Being NATO an institutional stakeholder, do you actually put so much emphasis on market attractiveness? Don't you prioritize based on strategy, autonomy in key dual-use tech areas, e.g. space, nuclear, AI, bioengineering, despite market not being ready in some cases?
It's a good question with a somewhat complicated answer. So for a dual-use technology to be valuable either to the defense or security sector has to be optimized both on cost and survivability of supply. So basically, to have a single supplier or to have a single customer doesn't actually work for defense and security. Why? Because you have one or few suppliers. You often have a solution business that cannot productize their technology in a way that lowers its cost and make it more addressable. So in a way, you really want the dual use case to be both commercial and defense because it actually works for both. And so, yes, we do care about proper dual use. We about commercial portfolio companies. And we believe that that is being strategic because of the reason I said. So for us, that it's an important point. For a technology to be successful with our investors as customer, has to be a technology that also has commercial application because our defense security customer will benefit from that cost down of that technology that is being forced by the commercial market. So I think it actually works both ways.
Great. I think that concludes the questions that we got from the audience. If you have any last burning questions, write them in. But we had one last question for you, Andrea. We always like to close out on advice and last, if you have any last wise thoughts that we should all bring home. Is there one piece of advice what is the one piece of advice that you would give deep tech founders and the founders that are on this call?
To basically think about your proposition from the endpoint backwards to today. It's very normal and human to start doing this in an incremental fashion and basically not ignore, but to underestimate what's coming down the line. Think about what your company could be if fully successful. How big can it get? What would it look like? What product would they sell? What is the go-to market? And then work backwards from that and be rigorous in going through all the steps and figure out what needs to happen for those steps to be successful and go backwards. So almost do a regression of your future to today. And then ask yourself, are the odds totally stacked against me? Or do I think I can get there with all the grit and doing the impossible that an entrepreneur needs to do? I think that the answer will still be yes, I will do it. I will start this business and I'll go for it because that's where the passion for the product and the technology is. But at least it sort of aligns expectations with co-founders, investors, early team members, and it provides a very clear path and a very clear North Star for where you want to take the company. That often changes, that's absolutely fine, but having a clear picture on day one is really, really important.
That's great. Thank you so much, Andrea. Thanks for everyone for participating and asking great questions, both in the lead up as we were preparing and now in the chat. If you have more questions, I see one more from Carlotta Ferrari, for instance. She's asking about how the NATO Innovation Fund works, but I don't know if you want to quickly answer this one, Andrea, otherwise we'll wrap it up.
We operate like absolutely a normal venture capital fund, with the only differences that I mentioned, that we have a longer period to invest in our companies. We have more capital to deploy in our company. And we have this internal team that helps our portfolio companies sell products and services to our investors. So from an operating model is the same, but we have these different capabilities that are quite unique in the market in deep tech.
Yeah, and in terms of mission, I think you've explained it. It's on the website too, if people want to find out more. But if you have more questions, don't hesitate to reach out to Ines or I, and we can make sure to route your questions to Andrea as needed. So thanks again. It was a great chat, a complicated topic, but really helpful to sort of break it down and try to understand all the phases that deep tech founders need to be thinking about, and especially how to approach fundraising when, you know, the timeline is so much more diluted in terms of getting to product market fit. And yes, you want to move fast, but you can move as fast as some of the other startups. So really interesting chat, and thank you. And I see a lot of thanks coming from the audience. So thanks a lot.
Thank you, Andrea.